Liquidity, where you find out how not to be fucking exit liquidity.
Before we hop into that, I want to hear a little bit more about kind of your background, the classic of your start in crypto. But we kind of center this question around the theme of the podcast, which is obviously exit liquidity. So could you just give us a little intro on your background and kind of some of the best moments that you were exit liquidity or most memorable ones?
Yeah, so I think my entrance was a little different than probably like a lot of people. So in like 2017, like around the spring time was I don't know how many people like know this or remember, but Turkey banned Wikipedia access to all those residing in Turkey. And I remember that just kind of being like a pretty like big like news article at the time. There wasn't really much more there. So but I kind of like filed the article, and like at the end of the year I kind of like review a lot of stuff I've saved, throughout the year. So nothing really happened like in for the rest of the year. But when I was reviewing it in December and just kind of like reading articles around the banning of Wikipedia in Turkey, a big thing was IPFS, and it was kind of like a moment for IPFS to shine, where they self-hosted a copy of Wikipedia for Turkey citizens, and they could access it in a decentralized way, right? And to me, that was kind of like just like a really like it's just like kind of the exact use case I feel like a lot of like applications within crypto like strive for, but it was just like my first like showing of it, right? So from there, like I don't know how many people really get into crypto through IPFS, but from there, I just kind of started like researching kind of like things like around that or like adjacent to it, and pretty quickly kind of found like Ethereum, kind of got on the wave of like programmable money. Obviously, like Bitcoin kind of came with that, and at the end of that year, right, was when when everything kind of crashed, at the end of 2017 there, and I entered like literally right after the crash, so like January, February 2018. And then I think like maybe it was like 8 to 10 months after that was when I kind of really started seeing like interesting applications like around Ethereum. I think one of the first ones was Chai, which is back live again. It was just token wrapper around the DAI savings rate. And then I just kind of got into like programming some smart contracts and all of that. And I finished up college a few years, after that, and just kind of focused on learning about DeFi stuff, trading, researching it, operating various infrastructure, and programming around it. I'm trying to think. I think like throughout the past few years here, like the overall theme for like where I'm exit liquidity is like markets that I am just not familiar with. Right. Like I think a really important thing is to kind of like find your niche within crypto and kind of stick to it. So like I've gotten consistently hosed on like NFT trades and within like NFT markets, just not understanding, value within that, or like within that market, or just like the various participants in it. So through that, I've just kind of figured, stay in my lane, stay to what I know and what I like. Because that's another thing I think that's pretty important too, is kind of like, being involved in markets and like projects that you're personally just interested in and passionate about as well. Yeah.
Yeah, I think that's a great beginning. I think the introduction to crypto through IPFS is pretty interesting. I think that's like a great summary of like a person's character, honestly. I think it's a quite special introduction. And you're definitely right. Like focusing on a niche in this sector seems kind of not really done often. Everyone tries to do everything at once. I know I have, even now, and especially early on. So we're going to get into derivatives here a bit. To set the stage a bit, I'm sure a bunch of people have read or kind of browsed Ali's work on this topic. He's definitely more well versed on it than I am. And so the way I kind of want to approach this is like a bare bones introductory aspect, kind of allow people to be able to listen to this episode at any point and follow along throughout the rest of the season when things get a little bit more complicated with different protocols. So if you could just kind of give us like a high level overview of derivatives contracts in traditional markets and how they're mainly used, like the main users, institutional or retail, and like highlights of the different products. And I wanted to ask specifically with this question about if you have dabbled in that sector a bit and like what was your introduction to it there?
Yeah, I can definitely do that. Let me think about my introduction. So I think that it's this maybe isn't a like that uncommon of a thing, now in 2023, but maybe back around like 2019, 2020, it probably was. So I had actually never traded any derivatives at all on across like any trad market, right? I had some like stocks here and there, but like options or futures in trad markets, like nothing. And my first introduction to it was kind of trading on this like first wave of derivative protocols within DeFi. So we're talking like Perp V1, we're talking like Hegic, or even like early like prediction markets like Augur, right? And I think that through kind of like trading some of those, I just kind of was like, all right, well, what does it look like from like the side of the market where there's actually like more participants, like far larger volume, far larger activity, and then I kind of started dabbling on more of like the trend side, right? So with regards to the first part of your question, like around just like what is a contract and kind of like what are some examples of it, right? I mean, like the super like easy but like more like succinct answer, right, is just like any type of like derivative contract is just some financial agreement that's like generally on top of an underlying or a spot asset. Generally, it's used for like hedging, like managing risk, or like speculation on top of the underlying without needing to like actually like own the actual asset. Like there's like through various like derivative contracts, you can often have like more efficient leverage. You can like more accurately like trade your preferences with regards to time and price, right? So like some super common ones like that are like widely adopted, right, are like futures and options. There's also like swaps and forwards, and then you can kind of get into like even like more like super niche like contracts that are much more so like OTC based between like a few parties, right? But generally like futures and options have like pretty like liquid markets within TradFi, of course, but also obviously like increasingly over the past few years here within DeFi. So like often, like whatever type of contract you're trading, it usually lets like an investor the option to kind of like gain exposure to this underlying asset in a market where like they might not be able to easily get exposure to it, right? Which can be for many reasons, which I'm excited to talk about, like kind of maybe like towards the end of this episode. But it can become like super interesting when like you want to start getting exposure to kind of like validators or miners and their like infrastructure. Like you can't really get direct exposure, but you can get like derivative exposure on top of them, right? Or like as like within DeFi here, like as there's like it can be kind of hard to like reason or like think about like how you would get like direct spot exposure to like change in gas prices or something like that, right? So like in this case, like a derivative contract makes a lot of sense on top of it, right?
Yeah, I see. I think that's, I don't know, for me, that's surprising that you gravitated towards the on-chain products even before you were interested in the TradFi ones. Just because I think it's just not fully fleshed out enough for it to be the only introduction. When you first kind of tested, I guess you could say, these early products and these newer products, what was that experience like? Did you even enjoy using half of them? Was there like a big shift into what we have today versus how it started? And maybe tap into some of the protocols you enjoy now, why you enjoy them, any kind of special things that you mess with today?
Yeah, absolutely. So I mean, like I, it was kind of funny because like when I first like started on some of those like early protocols, right? Like I didn't really know what I was looking for. Like to me, it was like an entirely new concept, right? And then like obviously I like looked it up and I was like, oh yeah, like these like just exist within like trend markets and stuff. So like I mean, on initial usage, like I didn't even really know what was good or what was bad with it, right? But like over time, and as I started like trading within like traditional markets as well, like I can kind of like start seeing that. And obviously we've seen over the past few years here like stuff drastically improve with regards to just like number of markets. If we're talking about like fixed derivatives, like or like fixed time, like increased number of like expiries, just like better liquidity, like tighter spreads. And I think that we'll move into this in a little bit, but like I feel like, or we can move into it in a little bit. I feel like kind of like the overall shift towards hybrid, like or like a mix between AMMs and order books has been a really strong driver over the past year or two here, along with the push for these, like, rather than these exchanges to just kind of like write all of their contracts and just kind of like throw it on top of Ethereum and, let Ethereum kind of operate all the infrastructure. This push towards these exchanges owning some part of their infrastructure, whether that's like an app chain that they run themselves in sequence, or it's something like an off-chain keeper network or a set of fillers or etc. I feel like both of those weren't really like strong concepts like 3 years ago, but now they're kind of like the adopted norm or getting to there. And that has just generally improved kind of like the overall experience across them. So I have two like favorites right now, which are on the perp side and on the option side. And those are Drift and Avio. So I think that like for a lot of what I kind of just mentioned, like on the Drift side, I think that they have built out really interesting and ineffective like routing around an order where like when I first place an order, right, it'll go to like their like direct to like a market maker auction, which would give like best price execution, or it'll kind of then move into kind of like this off-chain order book that they have via their keepers, and if not, like your order will just always get filled against the VAM, right? Which I think is like a very elegant way of kind of building on like around some of the like risks like of a VAM, and also kind of like allows for more niche markets to exist and exist well, just given you can ensure like good price execution, but like if not, like it'll just get filled by the passive liquidity providers of the VAM, right? And then on the ABO side, I think that like I really like that they kind of incorporated the OP stack. I think they have some of the top designers in the game. Like their UX is really fantastic all the time on everything they've kind of put out. I think with Zeta having like their futures and options paused and just having their perps, Avio is the only exchange to have integrated perps and options. I'm not entirely sure on that, but I'm pretty sure, which is obviously like a really nice thing to have when you're kind of like trading them together. I also think that like Avio definitely has a pretty good like start, given just like the amount of liquidity that they have like gained and across their vaults on the Ribbon side. So like they're going through this like token merger and stuff, but like as they incorporate the flow from the vaults into the exchange, I think that would be pretty powerful as well.
Yeah, I think those are definitely some good ones. I wanted to kind of double tap into bringing these products on chain. I think it's a very basic question and a very big one, but it's one I think is going to be like a theme across a lot of the protocols that we discuss. At the very top, like the overarching question is why do you think these protocols and these products need to be on chain? I think with lending and borrowing, it's a little bit more clear around like the ethos of crypto and DeFi in general. But with these specific products, what are the things gained when they're brought on chain besides like the basic decentralization? Are there any extra features or cool things that protocols are doing that they couldn't do if they weren't on chain? And do you see it as like a better product? Can an on chain product be better than an off chain one?
Yeah, I think definitely an on-chain product can be better than an off-chain one. I think that like right now there's kind of not that many that are, but I think that like as you think of like the benefits of being on-chain, right, outside of like the decentralization piece or like outside of like the like transparency piece or like the access side. Like a few of the things that you get are like obviously like you can have like really strong composability between a lot of these products that like in turn build out, things that like might be possible like off chain, right? With like agreements between like multiple parties and stuff. But like you can kind of like remove a lot of that trust and just like compose yourself or like the teams can compose together and you can have like kind of like pretty interesting things like just because I see Z on here I think like Drift released like a few days ago like this like leveraged like these leveraged swaps which were like composed across a few different protocols, which is super interesting. I think outside of that too, like outside of the composability, you can also build like more efficient structures, particularly around like newer markets, right? And like not to keep going back to some of the stuff that we've been saying around just like VAMs and like new market like discovery, but like the ability to build structures around like passive LPing, create vaults around it, you know, utilize kind of just like various like oracles to kind of like build markets around assets that like just generally would not have one like in a given trad like market is really powerful as well. I think that like there's definitely a lot of things that you can say, well, like, you know, just like talking about just like various like med stuff or just like slower transaction speed or worse price execution. Like there's a very, very long list of things that are worse. But I think that as new teams like continue building out like the next generations of their exchanges and their products, all of those become less of a problem. And in turn, we're given transparency, access, composability, and the potential for like more efficient structures.
Right, right. You've mentioned drift and VMMs a little bit, and I think that recently, especially, that's been a pretty hot topic with FT perp sunsetting for V2. And then obviously, I think Biggs was actually the one who, he's listening right now, is the one who wrote that thread about conflating good VMM with bad. I'm wondering if you can, I guess, explain real quickly what a virtual AMM is and kind of what your take is on that debate, whether you're on the side of, it's inherently flawed, it's still a new technology and has a lot of promise to it. It just needs to be implemented right. What are your thoughts on that?
Yeah, this is interesting. So like the like VAM versus like not VAM debate is like kind of like this month's like AMM versus like collab debate, right? And they're like both like all kind of similar, right? Like I think like in the past I've shared that like I'm not really on the side of AMMs or on the side of collabs. Like I think the future is like a hybrid. And similarly, like on the like to VAM or not to VAM, I think that like it has its use cases in like being implemented or not being implemented. And I think that like ultimately a combination of like utilizing a VAM as part of your exchange alongside, like more like traditional like order books with like an off-chain network or something like that, yeah, is kind of the way to go, right? I like it's kind of hard. Like I can see how it's very easy to point out the risks of like improperly developed VAMs, right? Just with regards to I don't know. I think you probably named like three or four like obviously like NFT Perp V1 and like or like Drift V1 or like Perp V1 like a lot of the initial implementations did have some problems with regards to their like insurance fund and payouts, right? And each protocol kind of handled those a little bit differently or like their sunsets or their pausing or like migrating to their v2, right? So it becomes like a pretty like easy thing to say that due to just like certain like implementations, like it can very easily just drain an insurance fund and like traders kind of like cannot get out of the exchange, right? I think like Noodles or Crypto Noodles like wrote really well about this in the like it was like VAM, PvP, Perpetual Ponzi or something like that. I think that was a great article. But I think that it's very hard to understate the benefits that a VAM gives you, which, is just like it's more efficient. Everything settles virtually. It allows you to trade virtually any price feed or oracle, which isn't necessarily like a thing that you can do quite easily with like a given spot market, right? I think, a few things to think about are like the majority of perp exchanges that have gotten like significant traction within DeFi, right, are like generally VAM based or have components of it, right? Yeah, I guess like I think that like it's something that is going to be like utilized in the future. It's just a matter of like taking the good components of it, implementing it, and then like incorporating it into like an overall exchange that features other components of, could be a spot AMM, could be like off-chain club. I think all of this stuff is just going to be mixed together as we kind of see the like pros and cons of each one as like more protocols, are built and fail or succeed, right? I think one interesting thing was, I think this was maybe back in 2021 Missouri conference in New York. The co-founder of, I remember being at a talk with the co-founder of Perpetual Protocol, and he kind of ended his talk. He was just like giving an overview of Perpetual Protocol, and he kind of ended his talk saying that like the next 2 to 3 years are going to be huge for VAMs, and that they are going to be like a very significant component to like the majority of exchanges going forward. And it took me a while to think about that because like at the time, I think that there was only like, I think they had like an archived post of like what a VAM is. So like there wasn't really much information on it or anything, but it's cool. It's kind of cool to see now, like in the last like few months here, like the conversation around it has really like heated up.
Yeah. I think there's a lot at play there that I think still has yet to be filled out. I think my kind of like simple thesis there, which I apply to a lot more than just perps, is just that when you have a new novel technology like this that's being, implemented in different ways, it's just going to take time before we see anything that really gets it right. I feel like you can apply that to like NFT finance, like alt L1s, L2s. I mean, people are always trying to dunk on Solana, but I think that that's like, the biggest thing they have going for them is just that they're early, and that I think people are holding them to, or trying to hold them to too high a standard before they should. So shifting over to options a little bit, I think I kind of have the same view there. I'm wondering, you mentioned you like Avo. The ribbon integration is obviously really exciting. I think it's clear that that's going to do a whole lot for their volume and subsequently help everything else. Where do you stand on what the future of options needs to look like, on-chain options needs to look like? What will kind of get us more adoption in that sector, and what do you think is like a fair timeline for something like that?
Yeah, we're this like super like the like when you kind of narrow down the like the DeFi derivatives market just into the options side, it becomes like it's just like super interested and fragmented with like tons of different ideas about like where we should go going forward, right? Like on the future side, like in I'm not entirely sure what year it was, like 2015 or 2016 or whatever, like when like perpetuals were like introduced, right? Like those just very like quickly became the like preferred way to trade futures, right? So as everything like moved on chain, it was just kind of very like, oh yeah, like of course we're just going to implement perps, right? But on the options side, they didn't really like have this like perp like product yet, right? So almost every option protocol to date has struggled with like liquidity fragmentation across like their strikes, and just like due to that, like not as many. It's also like not as easy of a thing to trade, right? As just kind of like 5x leverage long, right? So it's kind of gotten like stuck in this weird spot where like there's a lot of options protocols and like they're all like implemented like differently and like have like their strengths and their benefits and stuff, but it's kind of like, where do we see like adoption coming in, right? I don't know. Like I think that there's a few like kind of threads going right now. There's like some stuff around like everlasting options, right? From the kind of that like initial paradigm post, which like I think like only a few exchanges ever ended up implementing it and didn't really see that much traction. Like I think 01 on Solana had them, But outside of that, I don't really know many other exchanges that implemented everlasting, but I'm sure there's a few. Then there's also kind of this like concept of like replicated options, right? With like RMMs and stuff. There's also this concept of kind of like building like option payoffs that are like creating LP positions that look like option payoffs, right? Like kind of like Panoptic. And then there's also just like, Open ended up pivoting to like power perpetuals, right? So I think one of those is going to win out. I like, rather than just like spot like normal options. I think like one of those like 3 or 4 will end up being the preferred like option type. I just don't really know which one. I think I would lean towards EOs, but I don't know and I just don't really understand why more people haven't implemented them, I guess. But it's going to be an interesting thing to watch. Like I'm watching projects in all 4 of those verticals, as well, of course, as just like exchanges that like offer like normal options. But I think it's pretty hard to kind of say that like, given the like just the dominance of like perps on the future side, that like trading like options with like fixed expiries and stuff like would be the preferred options trade, right?
Right. I think, given that options is definitely the more niche of the 2 main derivatives products right now, I think it's definitely possible there's a good number of people who aren't feasible with the main approaches. You mentioned that you're kind of keeping an eye on all 4 of them, and you mentioned EOS is kind of your favorite right now. Can you talk a little bit about what each one is and what you see as the trade-offs?
Yep. Yeah. Okay. So first one, which has been getting like a pretty good amount of traction recently, I think, would be like Panoptic in kind of these option payoff or like building LP positions in a way that they like kind of like replicate option payoffs, right? And the kind of like the really core benefit for something like Panoptic is that they're just tapping into Uniswap liquidity, right? So you can essentially, trade options on any spot market, like on Uniswap. They're perpetual, and like you don't have to like worry about like unit sizing, and you can kind of like you also don't really have to worry about like picking specific strike prices. You can kind of just pick what you want, right? I think that they like that is a lot going for them. Just all of that customizability and kind of like freedom around kind of like the instrument that you want to trade. The kind of like con to that is that rather than like a normal option contract where the seller would kind of like receive like a premium up front from the buyer, like within Panoptic, this like premium is like accrued over time and paid out over time, which could definitely be something that people might like or might not like, right? But it's just like a very different concept than maybe someone that's like more familiar with like traditional like options. I think they ended up like releasing the like pricing model for this called like Streama, which is interesting and helpful. I think like the way I kind of see that is like I wasn't a market participant at the time, but like as perps initially entered, I would assume that people were very like, what is this funding rate like concept, right? And like it doesn't really make sense to me. Like, why is it like accrued every hour? Why does it change every hour or whatever, right? So I would hope that like in Panoptic's case, that is kind of like the initial sentiment now, but looking forward a few years out, it would become kind of like a standard.
Yeah. Panoptic's pricing is really interesting. For those who aren't familiar, given that the underlying infrastructure is UniV3 LP positions, the premium that a buyer pays for an option is the fees that position accumulates when it's in range. And I'm not fully sure how, but that does also converge with like traditional options pricing models. And I think that's a lot easier to wrap your head around as well, compared to like, if you're crypto native but you've never really looked at options, trying to wrap your head around Black-Scholes is a different thing versus understanding like, okay, if my position's in range, I will start to accumulate premium there.
Mm-hmm.
I would like to hear a little bit about, you alluded to this a little bit, but I didn't, I myself am not very familiar at all what are some other like more, I guess, more crypto native derivatives that are being worked on right now? Something outside the realm of futures or options, because that's really where all the attention is right now, I feel like.
Mhm.
But obviously, those are TradFi first products that are being brought on chain. What's some interesting stuff being built that's more unique to crypto?
Yeah, so I think like the kind of like the interesting thing is like it's either like these like unique products that are being brought in are either unique from the aspect of like they exist, but like they really are only like traded like institutionally, right? And not necessarily like to like a wider market, or like they exist, but like maybe like the asset that's being traded or like the like price feed that's being traded is like unique and different, right? So on the first side, that would be kind of like I think like over the last like few months here, like we've kind of started seeing like a lot more interest with protocols like Pendle, right? And these concepts behind like yield stripping, which is like a traditional thing, but like it becomes like kind of interesting when you pair the stripping around like validators, right? And all of a sudden you can kind of have this like collateral that's needed for like your ETH validator, and then you can kind of like separate that from you can separate the yield of that collateral out, and then you can kind of like trade either of them, right? It's kind of interesting how like a yield strip was like something I feel like if I had like learned about them first via traditional markets, I might not have really understood them as much. But coming at it from like the DeFi side, like it's kind of like I feel like it's a little bit easier to understand, because to me it's just, oh yeah, they're just two separate tokens, right? Like we just take this aspect of like stETH and we just separate two tokens out, right? And then on the like more like unique like price like feed side, right? Like one like area that I've been like really interested in, probably like within like for this year, has been starting to trade around block space derivatives, right? So like again, like these are kind of like traditional assets, like traditional like instruments like swaps or futures or forwards, but like now you can trade around, like you can trade swaps around like staking yield on each side, or you can trade like forwards around like Bitcoin like miner like production, right? Or like estimated like future production, right? And I think that like these can become like kind of interesting for a few different reasons. On the like mining or like validator side, right? They like either like put up some collateral or have some other type of like OpEx to secure whatever network that they're on, but like ultimately they're earning block subsidies and transaction fees, right? And like often that revenue that the validators or the miners are earning is like extremely volatile, right? That could be due to like super high or like variable like mev tips on the ETH side, or it could be due to like on the mining side, like increased heat in the summer, like down in Texas, where there's a bunch of miners, right? And the profitability and the revenue between both of them kind of like shift like wildly, to where that can be an interesting thing to trade, right? Like often, like miner revenue is actually like much more volatile than like actual Bitcoin price, right? The difference is though that like on the mining or on the validating side, like kind of like how we talked about like a little bit earlier about like how it could be kind of weird to like reason about like trading gas price, right? Without having it implemented in some type of like a VAM, like where you're trading the price feed. It can be very weird to like reason about like trading like mining production or validator yield, specifically more so like on the mining production side, right? Because like what are you going to do? Go like set like buy a ton of miners and like set it all up and stuff in some data centers, or like as a trader you might not even be like prepared to like rent a few AWS instances and stand up like a validator yourself, right? So as markets begin to like mature around them with these like swaps and futures, or like even like strips from Pendle, it can become very interesting to trade around them. One thing that I do think will be like is something we haven't really seen. Like all of those markets are still forming, but I think looking out even into like the farther future, that can be kind of interesting is like when you look at the production value that like a miner produces, right? What type of miner it is, where it's located, like how it mines, like what pool it's mining in, are all factors that like affect its individual profitability, right? But when you look on the validator side, like outside of just kind of like running standard things like MEV boost and stuff, like your yield is kind of your yield across, right? Like everyone's kind of earning just like about similar yield, right? So like it starts to like be not as interesting to like trade like that yield very specifically on like a certain validator. But something that could be interesting in the future is like kind of like physically settled swaps of validators in the activation or deactivation queue, where you like I have a validator that I'm trying to enter into the queue, but it might take 2 months for it to get like active. So instead, I pay some premium to like physically swap my validator with a validator that is like already active, which I think is kind of like a really weird thing to like reason about, but could probably be possible with like the emergence of like DVT tech. Sorry if I went on a little tangent there.
No, it's okay. Yeah, I had no idea something like that would even be feasible. But I mean, I guess with all the DVT tech stuff floating around and kind of the potential need behind something like that, I think it could be really interesting. When you were alluding to what I would assume is kind of like hash rate derivatives or like trading mining production, how is something like that brought onto DeFi, onto smart contracts? Because I mean, is it just Oracle based, or is that something that can be done a bit more securely, I guess? Or like what are the approaches look like right now?
Sure, yeah. So there's probably like two primary approaches, which is via Alchemia, which is the more interesting one, and via Luxor, which has a little bit more of a bootstrapped market. Luxor is only forwards and also only on the Bitcoin side. They have like a little bit more of like a liquid market. It's all like OTC, like actual contracts with like the people like at the company, right? Like not really like any aspect of DeFi whatsoever, like outside of the fact that you're kind of like trading these forwards on mining production, right? On the Alchemia side, it's one of the protocols that I'm probably like most interested in, and as they're kind of like launching out of their beta and stuff, and like they can see a lot of benefit of like fully integrating on the DeFi side when it pertains to like the block when they're deployed on a blockchain that has some type of like validating like underneath it, right? Because you can kind of just like integrate all of that natively. So like they offer Bitcoin stuff too, but you have to use like wrapped Bitcoin, deliver it daily. It's not necessarily like there's definitely still some like manual intervention and need on that side. But like on the ETH side, right? Like you could kind of like see the future where like I spin up a validator and the payout address for that validator is actually just like a smart contract that like continually deposits or continue delivers my yield into whatever Alchemia vault or whatever Alchemia contract I'm in for like that given time, right? And you can kind of see like how all of that stuff could just be like done via like smart contracts and kind of like automatically, which is super exciting.
Interesting. Yeah, I got to take some time to look into that because I heard stuff like this mentioned before, but I was never really too familiar. Quick heads up for the listeners, and if it's okay with you, Nate, I think we have a good amount of smart people in here, so it'd be a good idea in maybe 5-10 minutes or so to open this up to some questions if anyone's interested, or just I guess open discussion. But before we get into that, if there's interest, I want to talk a little bit about what kind of like end game is for you in the derivative space. Obviously, there's a lot of cool shit going on right now, and the market is still very up for grabs in a lot of different ways, I think. But in the long run, what is like a fully realized on-chain derivatives ecosystem look like to you, and how could that kind of be realized in the next, I don't know, 5 to 10 years?
Yeah. So yeah, like I guess a few things. I think like one, maybe a few years ago now, multi-coin had like released like a pretty good piece on like Durbit and like why Durbit had like been so successful, which had like a very large part to deal with the fact that they had perps like integrated like directly into their platform alongside their features and options and stuff. And that just kind of like having everything integrated and cross marginable and like easily like accessible for like market makers or like traders on their platform was like pretty much their advantage. And it just kind of continually compounded as like more people use the platform and more people like traded on and volumes were higher and stuff. And I think that is a very similar like concept for like what is needed within the derivative space in DeFi. You know, what we need to see like kind of like these like integrated products like all within a similar or all within like the same like protocol. They don't necessarily have to be built by the protocol. Like I think like Quanta like offers options, but it just actually routes you to Lira, which I think is great. I think like eventually like as you know various like protocols are like iterated on in their specific like niche, you know, there will be a winner in each one, and then someone will just kind of come through and like integrate all of the winners and kind of have like the best platform for it, right? But the other thing to like know it for like DeFi specific derivatives is that like it's not just the like integration of like all of the products and instruments and having like you know like good spreads and then like a lot of liquidity and stuff. Like there's also like a very important like infrastructure piece that I think you know some people are like looking at right now, others are, like maybe like aren't necessarily. But like when you're thinking about like running like I don't know like as like a centralized like exchange, right? Like a lot of the stuff that like there's probably like a lot of stuff that you take for granted, you know, in just like running like your your like matchmaking and like operating some like liquidators and just kind of like keeping keeping track of like users on the platform and stuff and like their account balances and all of that, right? Like a lot of that kind of like what we talked about like a little bit earlier is like afforded to you when you're using like a blockchain, but it's not always the best like implementation of it, right? So that's like where we're starting to see like various like derivative like DeFi derivative exchanges like own their own infrastructure, whether that's like some off-chain component or owning their own app chain. You know, they're starting to like integrate just like additional products. Like I think like one thing that is like also like interesting is integrating like multiple Oracle sources that are customizable as well. So something like Switchboard, right? Like I think like there's like a pretty like heavy reliance on like Pip or like Chainlink, which are great and they're pretty good price feeds, right? But like continuing to like build out that customizability and optionality, I guess, and that is important as well. And then probably the last thing is I think like a lot of price discovery for like major assets, right, is done not in DeFi, right? You know, I think that will kind of like move into DeFi over time, but where we're kind of like where I see like some of the most like some of the more successful like projects sit right now is like smaller cap assets or like niche assets. Like a majority of their price discovery does exist in DeFi, right? Usually it's just like across like Uniswap or like another set of AMMs or something like that. And like if you can like design your like derivatives exchange in a way that you know like protects like some of the risk like from those, like a lot of like users will be like inclined to use them because it's kind of like the only spot you can trade them, right? Like I think that's like a pretty good like NFT perp. I think is like a pretty good testament to that.
Yeah, lots to potentially impact there. I do. Oh, also, by the way, if anyone is interested in asking Nate or the group any questions, feel free to go ahead and request now. But while we wait for that, if anyone is interested, Nate, I also want to hear a little bit about. I don't really know too much about what it is you're spending most of your time on these days. Specifically, like I know you have this daily funding Telegram group, and then you have the adjacent research, which I've read about, or I've read what you guys have put out, but I'm not too familiar with what the kind of bigger vision is there. What do you spend most of your time on these days? And if you know if there's anything you want to share or tease for the people, feel free to do so at this point.
Yeah, absolutely. So I like the quick version of adjacent is, we've put out like a few research pieces that are very like forward looking. Like a lot of the stuff is like a lot of the stuff in it is like pretty like new markets, new or like new concept or new protocols that like I'm either just like interested in or excited about, or can see being like a common theme in the next like 6 months or like year or two or whatever. And then like occasionally we'll like build like public tools or like you know we'll keep them to ourselves so that we can like trade on those markets as they're ready and as they start to like make sense for us. And kind of like lastly, a lot of these new markets have a pretty like key infrastructure piece to them. These are the keepers, the fillers, the arbitrageurs, etc. And we like running those as well. I think as we see like more app chains and stuff like DYDXs, or like as this is still pretty far out, but like you know as like the OP stack kind of like starts like to centralize out their sequencers and stuff, like partaking in those is very interesting for us as well. Right, it's kind of the concept of like we're helping maintain the venues that we're trading on, right? And then kind of specifically like
Is there,
oh god
sorry, quick question. Is there any infrastructural component for any specific project that you've particularly enjoyed or found to be more profitable, maybe? Like, I don't know, keepers on Drift or like liquidation bots somewhere? Is there anything that kind of stands out to you?
yeah, it's kind of interesting. I think like I'll take it from the perspective of like operating like keepers or whatever like over on Solana versus like on like Ethereum or like on like an L2 there have been kind of like interesting just because of like the like amount of like it's just far cheaper in terms of like the transactions that I'm sending, and I think like often it's a weird concept where it's like there's like less like volume and there's less like actual like money to be made, but like at a higher profit like percentage. But yeah, like I've enjoyed like running keepers for like the various like or keepers and liquidators, I guess, for like the various like sets of Solana exchanges that are like kind of like poised here for like DeFi, like Solana DeFi Summer or whatever. Like there's like like MarginFi, like Cipher, Drift, like Zeta. I've enjoyed those.
Gotcha. Yeah, I've always been curious about that because I'm not yet at least technically savvy enough to run infrastructural components like that, but obviously in the reading that I do, I'm really curious as to what that process is like and just kind of how someone with little prior knowledge of the project can kind of come in and help contribute. I believe Jose requested to come on. Tito, is that right?
Yeah, I just pulled him up.
Awesome.
Good,
We had NFT Perp on. Oh man, must have been like a month and a half, 2 months ago now. So always good to have a familiar face back on. What's up, Jose?
Hey everyone, thanks for having me on. Yeah, I first of all wanted to thank Nate for this episode. It was really cool. I've been following your research and your work for quite some time, and it's cool to hear your voice and understanding your background and how you view the current on-chain derivatives market. And yeah, I also appreciate your take in terms of how you thought of the success and failures, trials and errors, different VAMs projects have gone through, us being one of the more recent ones. And I'm in agreement in terms of how a AMM plus order book type of model is the way to go in the future. And our V2 resemble a big portion of that, of our design, really sort of like align with your view over there. I think my two questions here that are more specific. I'm wondering, I think like at the end of the day, a lot of these DeFi derivatives exchanges is how flexible you are in terms of onboarding liquidity, sufficient liquidity for takers to enter trades. And that's one of the reasons why I think VAM is so attractive, because you can kind of spin up these exotic markets. Perhaps you don't have to rely on professional market makers or liquidity to create decent spreads or slippages for takers to bet on a directional bet, right? That's why VAM is so attractive for a lot of builders and exchanges to tap into. And that a big part of that is because when you run a fully on-chain or a centralized order book type of model, it's quite hard to onboard market makers, and depending on what type of market it is and pairs, sometimes operational costs, loaning of the capital, running an exchange, it could be expensive. And my question for you is, throughout your experience looking at different on-chain derivatives protocols, have you come across any specific exchanges or the way they go about onboarding liquidity one way or another, either through passive LP or active LP on DLOB or AMM, that you find quite efficient? And my second question was, I didn't know you were running a lot of different keepers and liquidating infrastructure for on-chain perps with different protocols. And I know for a fact that different liquidation mechanisms, reward distributions, make certain protocols more attractive to be a liquidator. So I'm wondering, do you have a preferred liquidation mechanism and payouts that you typically look out for as a liquidator?
Yeah, I appreciate that, and I appreciate the kind words. I'm going to take the second question first because I think it's pretty easy. I think so. Like when you are liquidating on a VAM, right? Like there's not like a need to really like supply the actual like asset, right? Like everything just kind of gets like net settled out into like whatever the USDC or whatever is like the collateral for the exchange, which is like really nice. Like that's very, very nice compared to like say like liquidating like on like Aave or like across Maker. Like of course you can just in the like common thing right now is like, or like it's been the common thing is just taking flash loans to provide it, but it's just like a little bit less complex, right? And then on the first question with regards to kind of like I guess like onboarding liquidity, whether passive or otherwise, there's been a lot of different approaches, right? I mean, like there's been some, and some of them have worked really well. Like I think like Rage did really well with like onboarding liquidity via their like vaults, and kind of like specifically like they had their like I think it was like their like 80-20 vault that kind of like replicated like a Uniswap LP or something like that. I think like also like some of their vaults were like nicely integrated with like other platforms. Can you guys still hear me?
Yep.
Okay, I just got a
Yeah, we can
notification
hear you.
and I got disconnected. I think the vault side is interesting. I think like obviously what we'll see is like the ribbon vaults be integrated into their exchange, which will be very helpful for the liquidity as well. Let's see. I think one thing that is like a pretty easy thing to like knock out is allowing for whatever chain you're on, whether it's like MSOL or JITOSOL or like Steth or something, like allowing the like staking like LSD for whatever chain you're on to be like a collateral token into your exchange is like a very easy way to kind of get like further liquidity, right? Because like I love trading while my collateral is also earning like 6 or 7% or whatever. And one thing that I also felt was pretty interesting at the time, although I don't know how it like specifically really applies to your question, is back like a year or two ago, like 0-1, they were just like a pure club, right? Like they had like no concept of like AMM or anything or like VAM. Like it was just a pure order book on Solana. They actually launched like vaults that mimicked like V2 and V3 like LPing because they kind of like were under the impression that like as like a passive like V2 LP, it was just like a very like familiar interface. And like I actually think like 0-1 didn't get that much traction, but I think relatively that was like a pretty well received move.
Yeah, this is quite relevant to what we're currently doing with our B2. Like our plan is to work with protocols like Elixir, and there's another up and coming protocol like one of our close friends is doing. That's essentially allowing anybody, retail included, to opt in for a vault that doesn't take custody or private keys of the asset and deploy like automated strategies onto the order book as if it was a AMM. You could opt into a V2 type of curve, which is full range, less capital efficient, but you could also opt into like a lit price based compressed liquidity, which is way more efficient in terms of capital. I had a good chat with the guys from Public Exchange, which is they recently launched a decentralized order book on chain perps on a Avalanche subnet. And before that, they were on Avalanche V1. They were using similar VAMP model, which is not exactly X, Y, and K type of curve. They were using the curve exchange concentrated liquidity model. but for a decent experience for traders to take order, it will cost like $2 million to have a proper TPL for users to have a good user experience. So I think it's moving more towards like a DLOP model where users can opt in for more sophisticated strategy, like kind of like Maverick, where right you can have like left side, right side combined type of model where it's readjusting liquidity for you going forward. Yeah, but appreciate your take there.
Yep, awesome. Thanks for the question.
Thanks, Jose. I appreciate that. Hopefully the founder / new dad life isn't too hard on you these days. Glad to see you guys are still putting in good work. Cool. We're a little bit over here, so we're gonna start to wrap up. Nate, thanks again so much for being on. Any last remarks? Anything you want to put on our radar, or I guess just keep us privy to before we wrap up here?
What was anyone talking like the last like 30 seconds here? I kind of got like disconnected again.
Yeah. I was just saying we're wrapping up here. If there's anything, any closing remarks, any last thing you want to share or put us on to before we end off here? Hello, can you hear me, Nate? All right, I think we're getting some.
Yeah, I think he got disconnected.
Here. All right, well we're on the back
The end
end
of the
here
episode,
anyways.
anyways.
Yeah, he just messaged me.
All right, that's episode 30. If you're new here, this is your first episode. We're gonna be doing a whole season with like a bunch of derivatives protocols. So tune in. Thanks everyone for coming out.
Thanks everyone, and thank you, Jose and Nate, even though I probably can't hear. Bye guys.